Hello everybody, we have just witnessed the first full-fledged budget of NDA 2.0. We have seen the first full-time woman finance minister making her budget presentation. There were calls all around to make it a budget which had more of fiscal stimulus in it to boost the ailing economy. But what we've seen is a prudent budget which has prioritized fiscal discipline over fiscal stimulus. Let's take a look at a few takeaways of the budget. The first is with regards to the FY20 tax collection revenue targets. A little bit ambitious, I must say, because although the targets were reduced, they were revised downwards from the interim budget that was presented in February, it still represents an 18% increase over last year from the provisional figures that were released by the government. So I must say it is a little ambitious, the revenue collection targets, but then let's hope for the best. The second fiscal stimulus, the second measure for fiscal stimulus was with regards to the capital infusion for state-run banks. The budget proposal included around rupees 70,000 crores of capital infusion for public sector banks. It also included supports to help the ailing NBFC sector in India. This was mainly through short-term credit guarantees for rated pooled assets. Now, some people might say that, this is throwing good money after bad, but we are of the opinion that these two measures can revitalize credit growth in the economy and in turn kickstart the Indian economy. We've also seen various measures with regards to tax on big cash withdrawals, surcharges on crorepati individuals, tax on petrol and diesel, and also the usual budget fixture, that is the push on infrastructure, that is rural infrastructure and urban and national infrastructure. But these lacked clarity, these points. So all in all, if we had to rate the budget, we would say it is a pragmatic budget which has given priority for fiscal discipline over fiscal stimulus, and we would say that it is a well-balanced budget. Coming to investors and the impact of the budget on the capital markets, we would like to highlight three main points over here. The first budget proposal, or rather a suggestion to SEBI, would be to increase the public float of listed companies to 35%. Currently, this is at 25%. The government is suggesting to SEBI to increase this to 35%. So, if SEBI looks into it, this would mean that the promoters of any listed company will not be able to hold more than 65% stake in their own company. This could lead to a lot of divesting of shares in the market. Just to understand the scope, in the BSE 500 universe, almost 3.17 trillion rupees of shares will need to be offloaded. So this is a huge number. So you can look at it in two ways. One, some of the MNCs might decide to delist their shares rather than going for offloading of shares. They might decide to delist their shares. The second, this liquidity, because if the public holds more, this would lead to liquidity in the markets. This can lead to a lot of wealth creation also for the investors. Now, going back a few years, actually some years, when we talk about the Janata Party government and the finance minister at that time, Mr. George Fernandez, he brought out a regulation saying that, if MNCs had to operate in India, their shares needed to be held by the public. So some of the bigwigs decided to leave India. Coca-Cola, IBM are prime examples. At the same time, we also had a few MNCs who listed their shares during that time: Colgate-Palmolive, Hindustan Unilever and Procter & Gamble. Now, these companies have actually generated a lot of wealth for the investors. In the same way, this opportunity, this increase in the number of shares can lead to a lot of wealth creation in the stock markets. The second measure was with regards to the surcharge that we talked about earlier on the crorepati individuals. Now, there is an uncertainty of whether the foreign portfolio investors are also included in this category. Now, the government had come out with a clarification that FPIs can register as non-individual entities, but the fact is a lot of FPIs are investing through trusts, etc. So, they come into the individual category. Now, if this goes forward, if this surcharge goes forward, it could have a negative impact on the FPI flows into India. And this is the uncertainty that we are also witnessing in the market in the recent days. We've seen negativity in the market because of uncertainty in the timeline of implementation of these measures. The third measure would be with regards to the stock buyback taxation. Earlier, stock buybacks were not taxed. But the dividend distribution, there was a tax of 20%. So some of the cash-rich companies, what they used to do was they used to announce stock buybacks instead of dividends because it was more tax efficient for them. But now with this taxation on the stock buybacks, more or less the playing field has been leveled. This can impact a lot of cash-rich companies, especially in the IT sector, because we've seen TCS, we've seen Infosys, we've seen Wipro coming out with stock buybacks to reward their shareholders. Even currently, there are around 15 buybacks going on, with Wipro being one of them. So these are the three measures that could have an impact on the capital markets and what we've seen in the budget proposals. Coming to the sectors, we talk about budget proposals and its impact on the sectors. One sector definitely that can have a positive impact is the public sector banks because of the capital infusion of 70,000 crores in that. So it is positive for the PSBs like State Bank of India, Bank of Baroda, Canara Bank, etc. Also, with the push on rural infrastructure, companies with a rural footprint can also benefit from the budget. Companies like Godrej Agro, Mahindra and Mahindra, Hindustan Unilever, ITC, etc. can all benefit from the infrastructure push. Water has been given importance, so companies in the water management sector can have a positive impact. Real estate and construction have also been focused on. So road builders like L&T, IRB Infra, realty companies can benefit. And also cement manufacturers like Ultratech and ACC can also benefit from all the budget proposals. Now, couple of sectors have also been negatively impacted because of the proposals, especially with regards to gold jewelers and the gold importers because of the import tax that has been increased. So that can have a negative impact for these for the companies in this sector. Also, with the long-term push and focus on electric vehicles, auto parts manufacturers and auto ancillaries manufacturers can be negatively impacted if they do not change their business model to suit the long-term business model. Coming to the current situation, we are now in the earnings season. The earnings season has not started out well, with TCS reporting one of its lowest margins because of higher wage costs. What we are seeing is a consumption slowdown, the delayed monsoons, volatility in the commodity prices because of the global uncertainties. The current earnings season, the June quarter numbers do not look all that positive. Pharmaceuticals and cement manufacturers can report good margins. At the same time, automobile manufacturers, automakers can report declining margins. Even the other day, the Automobile Manufacturers Association reported passenger vehicle sales numbers, which was one of the lowest in 2 decades. And also oil marketers like IOC, BPCL can also report low margins. So going forward, what we are seeing is we are in the midst of a global bull run, but the Indian markets have underperformed when you look at it globally. We have seen a decent correction in the last few days. We still keep suggesting accumulation on price declines. You can keep accumulating fundamentally strong, high quality stocks on declines. Mutual fund investors can continue and should continue with their systematic investment plans for the price volatility. Thank you and happy investing.